What's up, guys? It's Morgan from Lynchpin. Today, I want to talk about avoiding false signals and how I go about kind of avoiding getting caught in that trap of, hey, everything looked good, but now the position's going against me. So let's go. Avoiding false signals comes down to three different things, in my opinion. Number one being watch the price action and volume. This is why I harp repeatedly on trading the same stock over and over and over again, especially for day trading. Don't get me wrong, for investing, swing trading, catalyst trading, all of that kind of stuff, I'm okay with the fact of trading other stuff, but I'm telling you right now, for day trading, understanding how a stock normally moves, what a normal volume bar looks like, some of those types of things, that to me is actually really important. I don't care if it's algos, I don't care if it's human beings trading on the other side. You will start to recognize patterns, and so price and volume are number one indicators. Nothing supersedes them. I've yet to find anything at all, even close. Number two, use competing indicators. Here in a second, I'll show you a chart on Snap and the indicators that I use. The more of these indicators that indicate the same thing is taking place, the more confident I am that I have the right direction. Now, number three, this is probably the second most important thing behind price and volume, and that is cut your losses. If you do not have an exit plan, if a position goes against you, then you failed already. This is one of the worst things that I've ever done trading. It's something that I've battled with along with every one of you, and that's getting caught on the hopium, being so obstinate about the fact that, hey, I was right, it looked like it was going to go up, or it looked like it was going to go down. Listen, set aside the bias, set a target. If it drops below this, I'm out. If it goes above that, I'm out, depending on whether you're long or short, right? But that's all I'm saying is you have got to set those ground rules with yourself or you will lose. All right, so we've got Snap up here. I want to go and show you exactly what I'm using. So I've got my greed strategy, green over red. So when green is on top for this moving average exponential line, when green's on top, bulls are in control. When red's on top, bears are in control. So here's an example of that, red on top. Now, that's one indicator, the two of them combined, I should say. A1 trend reversal are these bubbles, okay? Purple means it's an unsure move, whether or not it's actually a down, like reversing, or it could be wrong. Notice that it's uncertain. I found this on a forum. I'm actually becoming more of a fan of the TTM scalper. That's actually these arrows. It's much quicker at signaling breakups and breakdowns. So I've been using that a lot more, and I highly recommend checking that out. That's actually a stock study within Thinkorswim. Now, RSI, you're going to notice something. I use an RSI 10 on a 5-minute chart. That for me has been the best. I play around with how long the period is on the RSI depending on the chart length. I actually use an RSI 6 on the daily chart because a lot of times that mirrors the movement better. But look at this. Check out this move in the chart for RSI 10 for a 5-minute chart. I actually love the parallels. I feel like it does a good job of showing. A1 better volume. I don't know how accurate this is. This appears to be pretty decent at showing how much of the volume is buys versus sells, but I just want to give you more background if you haven't seen a prior video on what I'm actually doing with my indicator. Now, because of that, again, going back to what I mentioned before, price action and volume are number one. If there's outlier volume, that's a good sign that the move breakup or breakdown is a lot better. Whereas, something like this is pretty small, okay, pretty insignificant. But on top of that, the more indicators that I have showing a reversal. So notice this, the cross happens here, but it's all the way back here for the reversal signal. Notice that there is no arrow here. Let's try removing this and see if there's an arrow up there. There is no arrow even up there for the TTM scalper alert. So notice how you're not always going to have the indicators all indicating the same way. They have different criteria, so they'll signal at different times. As many of those are going in your favor, the better. Does that mean your chart needs 25 indicators? Absolutely not. It becomes an absolute mess. Me, I try to keep it as simple as possible and have complementary, but not the same indicators so that I kind of have an idea whether it's a good move or a bad move. Notice this. reversal, reversal. Okay, I know that's purple, but as it starts to break down, you get the break here, then you get double arrows down here. That's pretty awesome. And it ended up being a perfect move. Here you only had the TTM scalper alert and then the moving averages. But again, volume was pretty heavy showing sells. So all of those indicated down. So going back to the original point of the video, to avoid false signals, number one, price action and volume are always king. And this is why I recommend trading the same stock repeatedly. It's why I day trade Snap constantly, is because you get used to how that stock moves. Number two, the more other indicators you have that are pointing the same direction, that is helpful. That is more confirmation and a higher probability that you're right in picking the direction that you're going. Number three, always have the exit plan. If you don't know where you're getting in or getting out, you shouldn't be making that trade. You need to know what the recent low is, and if it breaks that, normally the stock will push further down, and you need to know where that recent high is because the stock will normally push further up. So it's one of those things where, at least from a technical standpoint, you need some practice watching how the stock moves. Watch how a stock will double bottom or double top, hitting the same spot multiple times, and watch what it does. That's one thing about Snapchat that has been so helpful to me. If it's weak and it goes in and makes like a double top, usually it's pretty safe, like, hey, that's gonna fall off the table. But if it goes and hits that area again and it's got more significant volume, I know it's gonna break out. I'm buying calls and it goes to the upside. Or if it's bottoming down and it keeps hitting that, but the volume's getting thicker, then I know that it's going to be dropping off the table, so I'm grabbing puts. There is no perfect answer to this, but that combination of three factors is how I avoid getting false signals. What about you? What do you do to prevent getting caught in a position that goes against you? I'd love to hear about it down in the comments. Thanks so much for stopping by and tuning in. I appreciate every last one of you. Have a great rest of your day. We'll talk to you soon. Bye.